Hello everyone and thanks for watching Edupedia Word videos. This chapter is entitled The Money Markets and the Supply of Demand. In this video we are going to see the money markets, the discount and repo markets. Then we are going to talk about the parallel money markets, the supply of demand, the creation of credit. After that we are going to answer this question: what causes money supply to rise? By the end, we are going to focus on the relationship between money supply and the rate of interest rate. So let's get started. We now turn to the money markets, where participants, including financial institutions, are able to lend and borrow to and from each other. In these markets, debt typically have maturities of less than 1 year. It has been traditional to distinguish money markets from another set of financial markets, known as capital markets. In capital markets, borrowing typically takes place over a longer duration. Capital markets include the market for ordinary shares and longer-term government debt instruments, known in the UK as gilts, which pay periodic coupons. Central banks are also important participants in money markets. It is through the money markets that a central bank exercises control over interest rates. As we have seen throughout this chapter, the financial system has evolved rapidly and the money markets are no exception. This has widened the lending and borrowing opportunities for financial institutions. We take the case of the London market, which is normally divided into the discount and repo markets and the parallel or complementary markets. The discount and repo markets. The discount market is the market for commercial and or government bills. In the UK, these are known as treasury bills, and operations are conducted by the Debt Management Office, usually on a weekly basis. These markets are examples of discount markets because the instruments being traded are issued at a discount. In other words, the redemption price of the bills is greater than the issue price. The rate of discount on bills can be calculated by the size of the discount relative to the redemption value and is usually expressed as an annual rate. The discount market is also known as the traditional market because it was the market in which many central banks traditionally used to supply central bank money to financial institutions. For instance, if the Bank of England wanted to increase liquidity in the banking system, it could purchase from the bank's treasury bills, which had yet to reach maturity. This process is known as rediscounting. The emergence of the repo market is a more recent development dating back in the UK to the 1990s. As we saw earlier, repos have become an important potential source of wholesale funding for the financial system, both to implement monetary policy and to ensure finance. The Bank of England first began using repo operations to manage the liquidity of the financial system in 1997, when it undertook daily operations, repurchases of securities, usually occurring 2 weeks after the initial sale. This system was refined so that in 2006 operations became weekly and the repurchase period typically shortened to 1 week. However, the financial crisis caused the bank to modify its repo operations to manage liquidity for both purposes of monetary policy, but increasingly to ensure financial stability. These changes included a widening of the securities eligible as collateral for loans, a suspension of short-term repo operations, and an increased focus on longer-term repo operations. So, central banks like the Bank of England are prepared to provide central bank money through the creation of reserves. Central banks are thus the ultimate guarantor of sufficient liquidity in the monetary system and for this reason are known as the lender of last resort. Now, Let's talk about the parallel money markets. Like repo markets, complementary or parallel money markets have grown rapidly too. We focus here on two of the key parallel money markets. The interbank market involves wholesale loans from one bank to another over periods from one day to other banks. Banks with surplus liquidity lend to other banks, which then use this as the basis for loans to individuals and companies. The interbank market offers financial institutions considerable flexibility over the terms of their lending and borrowing, which can help financial institutions to manage the maturity profile of their balance sheets. However, compared with rates in the discount market, interbank rates can be higher. More than this, interbank rates can be volatile and sensitive to changes in the financial system's aggregate liquidity, such as the shortage in the late 2000s. The rate at which banks lend to each other is known as the interbank offered rate. The IBOR has a major influence on the other rates that banks charge. In the Eurozone, the IBOR is known as Euribor. In the UK, it is known as the LIBOR, where L stands for London. Another important parallel market involves certificates of deposit. As we saw earlier, CDs are a form of time deposit, but where the depositor, such as another financial institution, has a tradable certificate. This makes CDs a liquid debt instrument for the depositor, and as a result, rates of interest tend to be lower than the traditional time deposits. Reasons for the growth in parallel markets include the opening up of markets to international dealing, given the abolition of exchange controls in 1979, the deregulation of banking and money market dealing with, and the volatility of interest rates and exchange rates, and thus the desire of banks to keep funds in a form that can be readily switched from one form of deposit to another or from one currency to another. Now, let's talk about the supply of money. If money supply is to be monitored and possibly controlled, it is obviously necessary to measure it. But what should be included in the measure? Here, we need to distinguish between the monetary base and the broad money. In the monetary base, it consists of cash in circulation outside the central bank. Thus, in the Eurozone, the monetary base is given by the cash in circulation outside the European Central Bank. But the monetary base gives us a very poor indication of the effective money supply, since it excludes the most important source of liquidity for spending. We need to answer three questions for that. Should we include just sight deposits or time deposits as well? Should we include just retail deposits or wholesale deposits as well? And should we include just bank deposits or building society deposits as well? In the past, there has been a whole range of measures, each including different combinations of these accounts. However, financial deregulation, the abolition of foreign exchange controls, and the development of computer technology have led to huge changes in the financial sector throughout the world. This has led to a blurring of the distinctions between different types of accounts. It has also made it very easy to switch deposits from one type of account to another. So, for these reasons, the most usual measure that countries use for money supply is broad money, which in most cases includes both time and sight deposits, retail and wholesale deposits, and bank and building societies deposits. In the UK, this measure of broad money is known as M4. Let's see the Eurozone measures. Although the European Central Bank uses three measures of the money supply, they are different from those used by the Bank of England. The narrowest definition, M1, includes overnight deposits, that is to say call money as well as cash, and is thus much broader than the United Kingdom's narrow money measure. The broadest Eurozone measure, M3, is again broader than the United Kingdom's broadest measure, M4, since the Eurozone measure includes various other moderately liquid assets. The definitions of the three Eurozone aggregates are M1, which is cash in circulation with the public plus overnight deposits, M2, which is M1 plus the deposits with agreed maturity up to 2 years plus deposits redeemable up to 3 months notice, M3 equals M2 plus repos plus money market funds and paper plus debt securities with residual maturity up to 2 years. Now, what about the creation of credit, the simplest case? Well, to illustrate this process, it is in simplest form, assume that banks have just one type of liability, deposits, and two types of asset balances with the central bank to achieve liquidity and advances to customers. Banks want to achieve profitability while maintaining sufficient liquidity. Assume that they believe that sufficient liquidity will be achieved if 10% of their assets are held by as balances with the central bank. The remaining 90% will then be advanced to customers. In other words, the banks operate a 10% liquidity ratio. Assume initially that the combined balance sheet of the banks is as shown in this table. Total deposits are 100 billion euros, of which 10 billion euros or 10% are kept in balances with the central bank. The remaining 19 billion euros are lent to customers. Now, assume that the government spends more money, 10 billion euros, say on roads or hospitals. It pays for this with checks drawn on its account with the central bank. The people receiving the checks deposit them in their banks. Banks return these checks to the central bank and their balances correspondingly increase by 10 billion euros. The combined bank's balance sheet now is shown in this table. But this is not the end of the story. Banks now have surplus liquidity, with their balances in the central bank having increased to 20 billion euros. They now have a liquidity ratio of 20 divided by 110 or 18.2%. If they are to return to a 10% liquidity ratio, they need only retain 11 billion euros as balances at the central bank. The remaining 9 billion they can lend to customers. Assume now that the customers spend this €9 in shops and the shopkeepers deposit the checks in their bank accounts. When the checks are cleared, the balances in the central bank of the customer's bank will duly be debited by 9 billion euros. But the balances in the central bank of the shopkeepers' banks will be credited by 9 billion euros, leaving overall balances in the central bank unaltered. There is still a surplus of 9 billion euros over what it is required to maintain the 10% liquidity ratio. The new deposits of the 9 billion euros in the shopkeepers' banks, backed by balances in the central bank, can thus be used as the basis for further loans. 10% must be kept back in the central bank, but the remaining 90% can be lent out again. When the money is spent and the checks are cleared, this 8.1 billion euros will still remain as surplus balances in the central bank and can therefore be used as the basis for yet more loans. Again, 10% must be retained and the remaining 90% can be lent out. This process goes on and on until eventually the position is shown, as shown in this table. The initial increase in balances with the central bank of 10 billion euros has allowed banks to create new advances of 90 billion euros, making a total increase in money supply of 100 billion euros. This effect is known as the bank deposits multiplier. In this simple example, with a liquidity ratio of 1 divided by 10, that is to say 10%, the bank deposits multiplier is 10. An initial increase in deposits of 10 billion euros allowed total deposits to rise by 100 billion euros. In this simple word, therefore, the bank deposits multiplier is the inverse of the liquidity ratio, L. We remind you that the liquidity ratio is the proportion of a bank's total assets held in liquid form. Now let's have a look at the maths. The process of creation can be expressed mathematically as the sum of an infinite series. If A is the proportion of any deposit that is lent by banks, where A equals 1 minus L, then total deposits will expand by D0 times 1 divided by L. Thus, if there were an initial additional deposit D0 of 100 euros and if A equals 0.8, giving a liquidity ratio L of 0.2, total deposits would expand by 500 euros. The bank deposits multiplier is 5. Now, let's talk about the real world. In practice, the creation of credit is not as simple as this. There are 3 major complications. Banks' liquidity ratio may vary. Banks may choose a different liquidity ratio. At certain times, banks may decide that it is prudent to hold a bigger proportion of liquid assets. For example, if banks are worried about increased risks of default on loans, they may choose to hold a higher liquidity ratio to ensure that they have enough to meet customers' needs. Customers may not want to take up the credit on offer. Banks may wish to make additional loans, but customers may not want to borrow. There may be insufficient demand, but will the banks not then lower their interest rates, thus encouraging people to borrow? Possibly. Banks may not operate a simple liquidity ratio. The fact that banks hold a number of fairly liquid assets, such as short-term loans to other banks on the interbank market, bills of exchange and certificates of deposits, makes it difficult to identify a simple liquidity ratio. For example, if banks use 1 million euros in cash to purchase 1 million euros of bills, can we assume that the liquidity ratio has remained exactly the same? In other words, can we assume that near money assets such as bills are just as liquid as cash? If we assume that they are not, then has the liquidity ratio fallen? If so, by how much? Well, some of the extra cash may be withdrawn by the public. If extra cash comes into the banking system and as a result extra deposits are created, part of them may be held by households and non-bank firms, known in this context as non-bank private sector. This will result in an overall multiplier effect. This overall multiplier is known as the money multiplier. It is defined as the rise in total money supply expressed as a proportion of the rise in the monetary base that caused it. Let's try to answer this question. What causes money supply to rise? There are 4 sets of circumstances in which the money supply can rise. Banks choose to hold a lower liquidity ratio. In fact, if banks collectively choose to hold a lower liquidity ratio, they will have surplus liquidity. the banks have tended to choose a lower liquidity ratio over time because of the ensuring use of direct debits and credit card transactions. The non-bank private sector chooses to hold less cash. And here, households and firms may choose to hold less cash. Again, the reason may be a greater use of cards, direct debits, etc. This means that a greater proportion of the cash base will be held as deposits in banks rather than in people's wallets, purses, or safes outside banks. An inflow of funds from abroad. If the government intervenes in the foreign exchange market to maintain a rate of exchange below the equilibrium, there will be an excess demand for sterling. To maintain the exchange rate at this level, the Bank of England has to buy up the excess foreign currencies on offer with extra pounds, thereby building up the foreign currency reserves. A public sector deficit. The public sector net cash requirement is the difference between public sector expenditure and public sector receipts. Now, let's see the relationship between money supply and the rate of interest. Simple monetary theory often assumes that the supply of money is totally independent of interest rates. This is illustrated in this figure. The money supply is exogenous. It is assumed to be determined by the government or central bank. What the authorities choose is to be, or what they allow it to be, by their choice of the level and the method of financing, the PS and CR. In practice, however, even if narrow money were to be tightly controlled by the central bank, which is not, it would be very hard to have a precise control of broad money. More complex models, therefore, and especially Keynesian models, assume that money supply is endogenous, that it depends on the demand for money. The argument is that higher money demand will result in higher interest rates and in higher levels of money supplied. The result is an upward sloping money supply curve, as in this figure. The reasons for this are as follows. Increases in money supply may occur as a result of banks expanding credit in response to the demand for credit. This assumes that banks have surplus liquidity in the first place, or are happy to operate with lower liquidity. So higher demand for credit will drive up interest rates, making it more profitable for banks to supply more credit. Higher interest rates may encourage depositors to switch their deposits from sight accounts to time accounts. Since money is less likely to be withdrawn quickly from time accounts, banks may feel to need to hold less liquidity and therefore may decide to increase credit, thus expanding the money supply. High interest rates attract deposits from overseas. This increases the money supply to the extent that the Bank of England does not allow the exchange rate to appreciate in response. To summarize, an increase in demand for money raises interest rates, which in return increases the quantity of money supplied, a movement along an upward sloping money supply curve. Some economists go further still. They argue that not only is money endogenous, but the curve is effectively horizontal. Money supply expands passively to match the demand for money. Now, we saw that money supply can be defined in a number of different ways, depending on what items are included. A useful distinction is between narrow money and broad money. Bank deposits are a major proportion of broad money supply. The expansion of bank deposits is the major element in the expansion of the money supply. Bank deposits expand through a process of credit creation. In practice, it is difficult to predict the precise amount by which money supply will expand if there is an increase in cash. Money supply will rise if banks choose to hold a lower liquidity ratio, people choose to hold less cash outside the banks, there is a net inflow of funds from abroad, and the government runs a PCNCR, public sector surplus, and finances it by borrowing from the banking sector or from abroad. Simple monetary theories assumes that the supply of money is independent of interest rates. In practice, a rise in interest rates will often lead to an increase in money supply. So this is the end of this video. The next chapter will be related to the demand for money. Thank you very much for your attention.